I'm going to jump into the two bank statement programs that we offer and understanding how we calculate income and understanding why we do what we do as it relates to ability to repay. On our bank statement programs, we utilize, obviously, year history of bank statements, and that's the reason we have 2 years as opposed to 1 year. The reason we use the 2 years is if you were to use tax returns, you would need 2 years of income documentation. So the bank statements are the alternative to the 2 years of tax returns you would normally have to provide. They validate effectively through our formula the ability to repay based on showing that the borrower has had certain income that demonstrates they have the ability to make the payments. Again, going back to our discussion that if a lender has to defend themselves in court, there's documentation in the file that justifies why a loan was given. So now with that being said, we have two bank statement programs. We have a regular 5024 BS and we have a 5024 BS NP. What's the difference between the two? The programs are identical from a calculation standpoint of income, but the difference is that the regular bank statement program starts at a minimum FICO of 660 FICO on up. The non-prime program starts at a minimum of 580 on up. Obviously, the rates are better under the regular 24-month bank statement program. I'm not going to go into the specifics of loan limitations and LTVs, but obviously, there are a lot more favorable opportunities for a borrower with better credit. In fact, on our regular 24-month bank statement program, we offer 90% financing. There are limitations and restrictions where the borrower has to demonstrate prior home ownership. So at 90%, it's not for the first-time home buyer. We have higher reserve requirements, and we have a 740 FICO score requirement. So it's for the top-tier borrower that's really qualified to put 10% down without any kind of tax returns. Now, it's important to understand that these bank statement programs are only available to self-employed borrowers because the idea is that a W-2 borrower makes the income they report, bottom line. So you cannot have a borrower that is a W-2 wage earner getting a bank statement loan. There are exceptions to that where you have a husband and wife, and the husband is self-employed, and the wife is W-2 borrower. You can have a bank statement for that self-employed borrower and the spouse having a W-2 in the file. Obviously, you cannot have tax returns that include the husband in the file because then it would contradict the bank statement calculations. So it's important to understand the logic there as far as the bank statement programs. Another difference between the two bank statement programs is that the trade line requirements, the depth, and the history on the 24-month bank statement program compared to 24-month bank statement non-prime program is obviously a higher standard. Again, I'm not going to go into all those details. I'm going to have you look at the guidelines yourself and study them and understand the details there. But it's important to understand the differences between these products. And obviously, the philosophy that you have to accept is the higher the standard, the higher the FICO score, the higher documentation provided equates to better loan, better rates. That's what you need to understand. So the more documentation across the board is an opportunity for a borrower to get a more favorable program. That's important to understand. With that said, I'm going to go into some very important elements with regards to bank statement loans and understanding how we calculate income to deal with ability to repay. And it's important to understand the logic. There are three scenarios in bank statement loans. And again, remember we said borrower has to be self-employed. So the scenarios are where the borrower is using their personal bank statements to qualify. There's a scenario where the borrower has use of personal bank statements, but their business bank statements are separate. So they're using the personal bank statements as a vehicle to demonstrate the ability to repay. You have a case where the borrower does not transfer money. They have a separate personal and business, but they don't transfer the money to their personal bank accounts. They're using business bank statements. And the third scenario is where the borrower is using a personal account both for business and personal use. So you have, in many cases, professionals that run their business under their name. So they're depositing all their income straight into a personal account. It's commingled, effectively. For all intents and purposes, the second scenario of use of business bank statements and the case where the borrower is using a personal account commingled, they're very similar in calculations. Now, it's important to understand that in the first scenario that I described, which you're exclusively using personal bank statements, you still need to have 3 months business bank statements, not because you're using the business bank statements for calculation, but just to show that the borrower's income is coming from their business, that the accounts are separated. So it's there just for purposes of tracking the income that's coming into their personal account. Under the scenario where the borrower is using their personal bank statements to calculate income, the borrower's percentage of ownership of the business only needs to be 25%. They do not need to own any more than 25%. They're technically considered a self-employed borrower with 25% ownership of the business. In the case of the second scenario where you're using business bank statements and or a third scenario, which is a personal bank statement that's commingled, you need to own at least 80% of the business. Now, in the case of someone who's commingling income and using their personal account, more than likely they own 100%. Because if someone had a partner, I don't think they would be comfortable with money going into one partner's account. So that's not an issue. But in the case of a borrower who is using business bank statements, they would need to have at least 80% ownership in the business. And it's a very simple logic. Obviously, we're going to use the business bank statements for a formula to determine ability to repay. They have to be a substantial owner of the business. The exceptions to that rule are when you've got a husband and wife, and one of them is not on the loan, and the husband and wife own 50% each of the business. Maybe the wife is on the loan, but the husband is not, and she owns only 50%. Those are cases where exceptions are possible. Otherwise, if you had, in the case of 3 brothers who owned a business or 3 sisters who owned a business, and they're wanting to use, one of them decides to buy a property, excuse me, and they each own a third of the business, and use of the business bank statement would not work for them. Now, in the second scenario of the business bank statements being used, or a personal bank statement, option 3, where it's actually acting as a personal and business account, there is an important element that's necessary in order to qualify. That's the profit and loss statement that's required under those 2 scenarios. The profit and loss is not required if the borrower is just using 24 months personal bank statements to qualify. Again, you had 3 potential possibilities. I want to repeat: the personal bank statement, the business bank statement, and then the third one being a personal bank statement that acts as a business account and personal account concurrently. The second scenario and third scenario require the profit and loss statement. Why is the profit and loss important in that case? Because if we're using business bank statements or a commingled personal bank account, we cannot give the borrower 100% credit for those deposits. It doesn't make sense. There are a lot of programs out there that have variable formulas for calculating the income using the business accounts. We have what we believe to be a sensible way of calculating the income. Let's jump back to, we'll go through one by one, and we'll talk about how we calculate the first one, use of personal bank statements. We take the 24 months average deposits, and we use that as our tool for determining the borrower's income. We have to exclude non-income type of deposits. What are non-income deposits? Obviously, if there are transfers, those in our calculation. So we basically add up 24 months of deposits and divide by 24. But when we're adding up the 24 months of deposit, we have to exclude transfers because we're not going to include transfers as income. If there are one-time type of deposits, for example, I sold something, I sold a personal property, I sold my car, or I sold furniture, or whatever it is, and I deposited that money into my personal account. Again, go back to the philosophy of what I described earlier, ability to repay. understanding that we're using those deposits every month for 24 months to determine the borrower's ability to repay. Is selling a furniture a one-time event going to be, unless the person is a furniture salesman, that's not a source of income. That's an isolated one-time sale. That has to be excluded. I refinanced the house and I got cash out and I deposited in the account. That's not income. That's an isolated one-time deposit. What we're trying to do is determine the borrower's ability to repay, and by doing so, we have to exclude deposits that are non-income related. That's the same philosophy we're using in scenario 2 and 3, business bank statements, and the third one where there's commingling. That's why you'll see underwriting will ask for source of large deposits. If there are deposits out of the norm, we're going to ask for source of deposits simply because we don't know if we should include that. Is that a normal course of business, or is it a one-time isolated event that has nothing to do with their source of income? That's why large deposits need to be addressed. Now, you may have somebody in a business where they get large checks every other month or every quarter. That could still be income. That could be a bonus. But we need to identify that, and it's imperative to understand that. Now, one piece of this puzzle I must add that you need to be aware of is understanding NSFs and overdrafts. Again, why did I go into the whole ATR concept? Because it's important to understand that by using bank statements, we're trying to identify the borrower's ability to repay. If someone's constantly bouncing checks, it undermines the philosophy of using the bank statements as their ability to repay, because it's an indicator that this borrower is unable to make their payments. So it undermines compliance and guidelines and the idea of understanding the borrower's ability to repay. We allow a few number of NSFs, and we have a problem generally with overdrafts. Now, there are cases where overdrafts may be allowed. There are cases where there are bank accounts where accounts that have checks written transfer from other accounts. So that's an overdraft. There's room for exception. But if a borrower is repeatedly bouncing checks every single month, it's a big problem. Again, going back to the discussion about ability to repay, if we as a lender down the road have to defend our case that we believe that the borrower has the ability to repay, and we analyze so, by simply the borrower or their attorney pointing to all the NSFs could say, look, you saw all of these NSFs. Didn't you think there's a problem with this borrower being able to make their payments? It's true that you calculated the borrower's income based on deposits, but clearly this borrower was over their head, and you knew exactly what they were doing, and you set them up to fail. That's why NSFs are a hot button. It's important to understand that. Now, going back to the income calculation, the personal bank statements are the easiest to calculate. As I said, we take the 24 months deposits minus any exclusionary deposits, as I described, and you average that out, and there's your income. An important element to be aware of in our new guidelines, whether you're using option 1, 2, or 3 from an income calculation, the 1003 income is critical to this calculation. If the income that's calculated using the deposit is more than what was on the 1003 and signed by borrower, that's a problem, because we have to use the lower of the two. So the income of the borrower on the 1003 has to be an amount that the borrower qualifies. Otherwise, we have to take the lower of the two calculations, because technically the borrower is giving us a loan application that he or she is saying, I make X amount of money, regardless of what we calculate on the bank statement. So we cannot ignore that any longer, and our new guidelines say that we need to take the lower of what's on the 1003 or the bank statement calculation. This is critical, and it's something to be aware of. Let's move on to calculation of use of business bank statements and P&L. The business bank statements and the personal commingled bank statement, the third option that I mentioned, operate in a very similar manner. We're requiring a profit and loss statement, one profit and loss statement on an accountant letterhead, unaudited, for the 24-month period matching the bank statements. This is imperative. Getting a P&L that's on a calendar basis that has nothing to do with our timeline of the bank statements means nothing. It's useless. So what we're expecting to do in, again, option 2 and 3 of calculation, which is business bank statements or personal commingled bank statements, is that we are taking the deposits for that 24-month period as a determination, and again, we're excluding all of the factors that we talked about, transfers and non-business deposits and so on and so forth. We're taking those net deposits and we are adding them up on the P&L to determine the gross revenue on the P&L. That's how the business bank statements play into the P&L. The total deposits of the business bank statements are the gross revenue for the profit and loss that's provided on an accountant letterhead. Doesn't have to be a licensed CPA. Just has to be a licensed tax professional. It's unaudited. So what happens is, by adding up all the deposits minus transfers and exclusionary numbers, by adding that up, we determine the gross revenue on the P&L. The borrower, for the same time period that the P&L is prepared for, which matches the business bank statements, is going to provide the accountant a list of expenses. Again, it's unaudited. Rent, salaries, auto expense. And again, the idea is that most self-employed borrowers run their personal expenses through their business. So this gives them an opportunity to exclude those personal expenses and provide true business expenses in calculating the profit and loss statement. So the borrower is going to give the accountant this information, and effectively the accountant will take the gross revenue, which was a formula of adding up the deposits on the business bank statements, again, minus any exclusionary amounts, taking the expenses that are provided by the borrower, unaudited, and determining the net income for the 24-month period. Without this P&L, business bank statements are useless by themselves. The P&L net income that's calculated, which was the gross revenue that came from the business bank statements, minus the expenses, determines the net income at the bottom of the P&L. That net income is divided by 24 to determine the borrower's income. It's critical to understand where the borrower's income comes from. Now, again, the same concept applies. If you divide that net income for the 24 months from the P&L by 24, but that amount is higher than what's on the 1003 that was signed by the borrower, you have a problem. You still have to take the lower of the two. It's important to understand. Again, you have to think ATR. You have to think about a potential foreclosure process where the borrower can show up with their loan application and say, look, they calculated my income was $1,000 a month, but I put on my application and I signed that I actually make $500 a month. What were you thinking giving me a loan? You set me up to fail. These are factors that lead to ATR. There is a logic behind these guidelines, and it's important for all of us to understand that logic on our daily process of these loans and handling them and funding them. So these are important elements. Again, the third option was the personal account commingled. Same concept with the P&L. Again, what's important to understand in preparing the P&L, it's unaudited, and the borrowers need to exclude any personal expenses. What we're trying to get is a profit and loss that tells us what it really costs to operate this business, not necessarily all the expenses personal that they usually pay from their business to avoid paying taxes. That's the opportunity of using this profit and loss statement. And it has to make sense for the business. Obviously, if I'm in a consulting business working out of my house, more than likely I don't have a lot of expenses. If I'm operating a restaurant, that's a lot different than being a consultant working from my house. My expenses, my overhead, it's going to be a different percentage. So it has to be sensible, it has to be logical. This is extremely important to understand. So that explains on a high level the bank statement products and understanding the logic between these programs. Again, when we're dealing with owner-occupied second home, the attention to ATR is much more than when we're dealing with a property that's being acquired or being refinanced as an investment property.